Hello and welcome to today's lesson. Now, whether you're investing, whether you're just working, doing your day-to-day activities, everyone exposes themselves to risk. Your personality and your lifestyle play a very big role in how much risk you are comfortably able to take on as an individual. Now, it is a general perception that people with less disposable income tend to be, by necessity, of course, more risk averse. While on the other hand, let's say day traders feel if they aren't making dozens of trades a day, there's a problem. So people like this tend to be risk lovers. Now, when investing in stocks or bonds or any other investment instrument, there is a lot more risk than you'd think. And in today's lesson, we will be looking at the different kinds of risks that often threaten investors' returns. So let us start by defining what this risk means. Now, this is the chance that an investor's actual return will be less than the expected return. It includes the possibility of losing some or all of your original investment as an investor. Okay, so that is what risk in investment means. So let us look at the types of risk in the general investment environment. The first type of risk is systematic risk. This is the risk that influences a large number of assets, and it is virtually impossible to protect yourself against this type of risk. And a good example would be, for example, the COVID-19 pandemic or a political event. A general occurrence that affects several or even most of the assets in your portfolio. So this kind of risk is virtually impossible to protect yourself against, and this is the type of risk we call systematic risk. The second kind is unsystematic risk, which is also sometimes referred to as specific risk. This is the kind of risk that affects a very small number of assets. Now, an example would be a strike by employees in a company you've invested in. You've bought shares of a certain company and employees strike. Diversification is the only way to protect yourself from unsystematic risk. So at least this one you can diversify. We'll look at diversification deeply in another video. So let's say you have a portfolio that is wide. So you've invested in different industries in the market. So at least you can diversify. One asset could perform better. So you could be having this effect in one company, while another company's assets are performing better, another company's security is performing better, and it sort of makes up for the loss that you're getting from the risk, this unsystematic risk you're facing in one asset or a number of assets. So diversification is going to be able to protect you against unsystematic risk. The third type of risk is credit or default risk. Now, this is the risk that a company or individual will be unable to pay the contractual interest or principal on its debt obligation. This risk is the type of risk that is of particular concern to investors who hold bonds in their portfolios. Now, it is important for you to note that government bonds, especially those issued by federal governments, have the least amount of default risk, but they have the lowest returns. Now, corporate bonds, they tend to have the highest amount of default risk, but also they are very high in interest rates. So bonds with a lower chance of default are considered to be investment grade, while bonds with higher chances of default, like we've said, corporate, are considered to be junk bonds. How do you know a bond is junk bond or a bond is investment grade? Now, bond rating services allows investors to determine this: which bonds are investment grade and which bonds are junk bonds. Okay, so the bond rating services will help rate the kind of bonds that are junk and the kind of bonds that are investment grade. The third type of risk is credit or default risk. What is this? This refers to the risk that a country won't be able to honor its financial commitments. So, when a country defaults on its obligations, it can harm the performance of all other financial instruments in that country. Not only in that country, but in other countries that have relations with this country. Okay? So country risk applies to stocks, bonds, mutual funds, options, and futures. These are the ones that are issued within a particular country, okay? Now, this type of risk is most often seen in emerging markets or countries that have severe deficits. That's where you're mostly going to be exposed to this type of risk called country risk. Now, the other type of risk is foreign exchange risk. Foreign exchange risk. Now, when investing in foreign countries, you must consider the fact that currency exchange rates can change the price of the asset as well. So, the exchange rates of the country that you've been invested in will affect the price of the asset as well. So this applies to all financial instruments that are in a currency other than your domestic currency. So you've invested in a foreign country. The currency exchange rate in that country will affect the price of the assets that you've invested in that country. So let us look at an example. Maybe you're a resident of America, let's say. You've invested in Kenya, let's say, the Kenyan stock market, in Kenyan shillings. Yeah? Even if the share value appreciates, you may lose money if the Kenyan shilling depreciates in relation to the American dollar. So that is a fact you have to consider. Even if the Kenyan share value appreciates, you can still lose money if the Kenyan shilling depreciates in relation to the American dollar, if you're an American citizen investing in the Kenyan market. The next type of risk is interest rate risk. This is the risk that an investor's value will change as a result of a change in interest rates. This risk affects the value of bonds more directly than stocks. Mostly it affects bonds more directly than it affects stocks. So it is that risk that your investment value will change as a result of change in interest rates. Now, the other type of risk is political risk. Political risk. That is number 7. Now, political risk represents a financial risk that a country's government will suddenly change its policies. If you look at it, this is one of the major reasons why developing countries lack foreign investment, because this risk is very, very high in developing countries. So governments just change policies, for some reason. So there's that risk of there's that risk of a country's government suddenly changing policies, and of course that is going to affect your investment as an investor. So mostly foreign investors tend to shy away from developing countries because of this. The other risk is risk number 8 is market risk. Now, this is most familiar of all risks. It is also referred to as volatility risk. And market risk is the day-to-day fluctuations in stocks prices. It applies mainly to stocks and options. So as a whole, stocks tend to perform well during bull markets and perform poorly during a bear market. So a bull market is when the market is in boom. Bear market is when it's in recession. So volatility is not so much a cause, but an effect of certain market forces. So it is a measure of risk because it refers to the behavior or temperament of your investment rather than the reason for this behavior. Yes, so because market movements is basically the reason why people can make money from stocks, unless you're talking about dividend payments. But those movements in markets are the reason why most people who make money in stocks make money. They just take advantage of those movements. So volatility is essential for returns. And the more unstable the investment, the more chance there is that it will experience a dramatic change in either direction. Yeah. So of course, if the share prices don't change at all, then you're probably not going to make any money. So, but now the thing is, it could be changing, negatively. So there's that risk. So the more unstable the investment, the more chances there is that it will experience a dramatic change in either direction. So it could favor you, prices are moving up, or it could, provide this market risk. There's that risk that prices will change, yes, but they are going to change negatively, or they're going to fall. The prices of the shares are going to go down and you're losing on your investment. So that's it, guys, for risks that investors mostly face in the investment environment. Systematic risk is one, and systematic risk number 2, credit or default risk, country risk, foreign exchange risk, interest rate risk, political risk, and market risk, also known as volatility risk. So thank you so much, guys, for watching. Please give the video a thumbs up. If you have any question, leave the question or comment down in the comment section down below, and let me know what you think, or let me know what your question is. Please consider subscribing to our YouTube channel, and we will appreciate. Thank you, and God bless.